Well, thank you everyone for coming. We really appreciate it. We're really excited to have a conversation with you today to talk a little bit about both kind of what 2025 brought us, what 2026 may potentially bring us, and chat a little bit about kind of the conversation the merger we've had with Pete and give you an update there as well. For those of you who don't know me, my name's Allison Barrientos. I'm a partner at the firm. I also am the partner who's in the Salinas office the most, so you may see me if you stop by, get to know me. Alex Black is also often in the Salinas office if you have not met him. We've got Kevin Mahoney, one of my business partners as well. Adri, who is permanently in the Salinas office. She is supporting you when it comes to things like paperwork, money transfers, eventually notaries and things like that. We've also got Michelle in the back, who is our office manager, Mike Levy, who's our chief investment officer, and Pete needs no introduction and has a few things that he'd like to say.
Thank you. And thank everybody for being here. It's a real blessing. We've been doing this for a number of years, and I always enjoy it because every year there have been surprises, and there's likely to be surprises in the coming year. The transition, which began in, say, March of 2025, has really been working well. And what's been especially enjoyable is to find that Integris fit in terms of investment ideas and portfolio diversification essentially aligns completely with what I am, what I'm thinking and how portfolios should work over the decades. And one of the things that was really good about this was when I got there, I literally walked in on the first day and said, okay, I'm going to just continue my normal work. And they jumped on every task like it was a loose football. And since then, I've been doing less and less work and more oversight. And I'm going to cover that in a little minute here. But the big core takeaway is that Integris really meshes with what I wanted to bring to investment advising, and it really has the integrity that I was looking for. I needed spotless integrity, and I've really looked, and they're doing great. Now, on to what happened in the financial markets. If you had predicted at the beginning of 2025 what would happen, you probably wouldn't have gotten them right. Mike is the genius in residence for investments, and he and I enjoy agreeing a lot with each other and enjoy scaring each other with hypotheses. One thing I've said in the past, again and again and again, is we are all in a big experiment. I've said that before. And the other thing is that media makes its living by producing attractive content that you will click on or buy. Most of the predictions that you get tend to be catastrophic. This is The Economist. The world ahead, 2026, they got everything except, as Dr. Cambier said once, dancing monkeys. This thing is chock full of potential dire consequences. Norm Hoffman over there is a weatherman, and he will tell you that Salinas weather usually features a prediction of 10 out of the next 4 storms. In other words, storms get predicted, but that doesn't mean they happen. So what you're going to see here is us kind of examining scenarios, but if 2025 proved anything, it is that we really can't predict. However, themes do work. Themes mean trends in interest rates or valuations that tell us, another buzzword of mine is we can see it coming, but we can't tell when. Remember that? I drilled that in again and again and again. And this is an example, and I'll discuss that later. This is the Million Bolivar note. Trends do emerge. We don't know when they're going to become a feature, but they can become a feature, or they can fade to nothingness. We don't know. Now, 2026 is going to be a big year for everyone. 2026 is going to be a big year for me. I was expecting that I would work until I was 90 because my family has a history of living into their hundreds. And then I started to think about it as everyone else did all the work. I mean, now I'm in a supervisory role. When somebody does something with you, there's an email chain and a task chain that goes out, a very complex technological event that Adri is involved with. And the result is that I am overwatching. I'm watching. I like what I see. I have never had to call anyone at Integris to disagree with them about anything. And then I read this. This is a book about career paths. And it hypothesizes that all careers have a trajectory. And you don't want to get out when you drive into the pavement. And what I want for you, everybody in this room, including my wife and the people who help me in terms of the finances, is I want you to have the absolute best cutting edge investment advising when you seek any kind of investment advising out. I want you to be with somebody in a meeting who is on the top of his or her game. And so for that reason, the fact that I have clients talking about trout fishing so much, I am going to gradually continue to step back. And in the spring of 2026, I'm going to step back to just simply an advisory role. So that's my departure plan. Please make appointments, have lunch with me, talk to me about it. But my basic plan is I am going to step back and compete with you for trout and quail and camping. So please talk to me if you have any concerns about this, but I'm going to just keep stepping back until finally, probably in the spring, I'm going to sever my connection with Integris's network, so I won't be able to see your portfolios. I'm going to do that for cybersecurity reasons, if nothing else.
But you won't be going away.
I won't be going away. I'm still going to be around. I'll still be sending him Wall Street Journal articles, and I'll still be interested in how you guys are doing. So expect my personal outreach. Thank you very much. Now, on with it.
So first and foremost, on the compliance side, we have a requirement to give a disclaimer. The presentation is intended for educational purposes and should not be considered investment advice. If you want investment advice, we want to speak to you specifically about your portfolio. And then a reminder that investing involves the risk of loss. What we want to talk about today are kind of three major themes. First and foremost, kind of what happened in 2025. What we see coming down the line in 2026, and what really matters as it relates to portfolio management when you're thinking about all of these themes. So let's jump into 2025 in review. There's quite a few things on the positive side. Global stock and bond markets had a really strong year in 2025. Kind of just closing out the year, large U.S. equities were up about 17% for the year. Remember that included all of the difficulties that we saw in the spring with the tariff announcements that came out. So all in all, that was really, really positive. Large international equities were up 35%, which is a pretty incredible year. So we saw the international stock markets diversify and add to global returns. The most recent reading for US GDP was 4.3%, and it surpassed prior strong readings. And then the Fed lowered interest rates at the end of the year, so that helps to stimulate growth. Potential reasons for concern were that the unemployment rate was a little bit higher. It's the highest level since 2021. The preferred inflation measure, which is core PCE is personal consumption expenditures, remained relatively stubborn, a little bit higher than the target of 2% at 2.8. High global stock valuations, particularly in the US, we'll walk through kind of what that looks like. And then 5 of those magnificent 7 stocks that everybody hears about actually lagged the S&P 500 performance, and that's the first time that it's happened in a number of years. And then we've just seen some expanding geopolitical conflict to end the year and continuing to heat up as we start the year. We're only a few weeks in and we've seen quite a few headlines. So jumping into the details, we'll hear from Mike and Pete.
I want to see if Mike here had on his bingo card for 2025 let's raise tariffs through the ceiling and have the economy go up 4.3% and the stock market boom. Did you have that on your bingo card?
I would not say I did, no.
Yeah, okay. I didn't either.
Yeah, and this is just a little bit of detail about what, some of the major economic indicators. You've got the PCE, which is, as Allison mentioned, personal consumption expenditures. It's a little bit different than CPI, but kind of the same idea. The Fed really likes that measure because it's a little more representative of inflation across everything. CPI is a little more focused. And that's been pretty stable. I think the Fed would like to see it lower, but it's not particularly concerning to have it at this level. We're pretty happy about it just staying in here for now. And then you've got inflation adjusted GDP growth. That's been very strong, which, again, as Peter's pointing out, that's quite, why is that happening when we've got tariffs and so forth? That could be dampening the economy, but we're still resilient, and that's good to see. It's a good sign. And then unemployment is ticking up. That could be concerning long term if it stays that way, but nothing totally catastrophic at this point, but something to keep an eye on. So this is just kind of where things sit as of the end of the year.
Now, I want to add something else, and that is, this is time number 1 million through my career that political investing, investing based on the political climate failed once again. I have yet to see somebody successfully invest based on political bias of what's going on. I've had people call up for different presidents and whatever and say they want this or that. It hasn't worked yet, because here we are. Look at this, really something.
I would say the biggest politically motivated thing that happened was the tariff. All of those tariff, in April, the tariffs were expected to be much higher, what was being put out by the administration. And the markets didn't like that long term, and so you saw a big drop, a big correction in the markets when that was happening. But as soon as that kind of got reversed and it became clear that that tariffs were going to be a little more muted, markets came right back. And as of the end of the year, obviously we've had a great year. So, politics aside, the markets have done excellent this year.
And I think it's worth noting that the markets weren't reacting to the politics of the tariffs. It's just that if tariffs are much higher than expected, then profits go down, and therefore the markets won't see as positive returns.
Yeah, the markets are going to react to their expectations of things that affect investments, which are not always the same as people's beliefs about what the right course of action is overall. I think this is an interesting chart because what it shows is if you've been paying attention for the last 15, 20 years, it seems like the U.S. is the best place to invest. It's been blowing away international for many years now. And that's partly because U.S. stocks themselves have been doing better, U.S. companies have been performing better. It's also because the dollar's been very strong. And when we're invested in international stocks, basically we're invested in those currencies too. So you have, if the dollar's going up versus everything else, you're actually losing money in your international investments from that effect. So you can see the last two, like the 10s and the 20s, U.S. stocks have done much better than international stocks. Purple is international, orange is U.S. Whereas this year, it's flipped around, and the dollar's been weak, and non-U.S. companies have been actually outperforming on their own local currency basis as well. So it's been very helpful to have international diversification in 25. But if you look back historically, and this goes back and forth, and that's one of the things to keep in mind is, if you look at the last 20 years, you might think, well, U.S. is so great, is the only place to be, but in reality, it goes back and forth. Valuations go back and forth between international and U.S. And so back in the 70s and 80s, you've got international stocks for almost 20 years outperforming, and then you've got in 2000s when the dot-com bubble burst, you actually had 10 years of negative real total returns in the U.S. Now international didn't do great, but it did a lot better than the U.S. in there. So it's good to have that diversification is kind of the point of this, and it does go back and forth over long periods of time in terms of where you're going to get the most returns.
Now, let me go back one for me, please. There's a couple of things I want to point out to add to this. Number one, remember how we kept buying that international and it would just kind of lay there like roadkill, right? People would say, why do you own this? Well, the purple-blue thing is international invested in dollars. In other words, what we actually own. The green is in their currencies. And finally, we got real traction on holding that diversification in international equities. So when you look at your annual report, you're going to see that. Hallelujah. The second thing I want to point out is the 2000s. Everybody here who went through the 2000s with me remembers that as a terrible decade. If you look, the stock market actually did negative 0.9. 10 years to do that is a long, long, long time. And we didn't do that because we were diversified. And I have really watched Integris for this. They have the same level of protectiveness that I had, and I feel very comfortable going in. We cannot say that there's a storm ahead, but valuations say something's out there. We can see it coming, but we can't say when. Could be another decade, we don't know. But when it happens, the diversification that you have in your portfolios should produce results that protect us against that kind of horrible decade.
So this chart really kind of gives you a sense of the U.S. This is all the U.S. market, and it shows the concentration in the U.S., which has gotten more and more pronounced in the last 10 years, say. So the top 7 stocks, the Mag 7, which are almost all, you can see, if you can see them, they're, I think only 2 of them, Tesla and Amazon, are not purely tech stocks. Everything else is really a tech stock. Those make up 35% of the S&P 500 now, so that's a really big piece, more than a third. And you can see the green lines there representing the returns to those stocks specifically, those 7. And then the blue is sort of the rest of the index, and the red in the middle is everything combined. But you can see they sort of dominate the returns of the index over this period of time. And I think that's great. I mean, they've made the S&P do really well, but on the other hand, that concentration introduces risk to portfolios. And so that just points to the reasons you want to be internationally diversified. In our portfolios, we generally put some small cap value stocks in addition to the large cap S&P 500 type of stocks for the US. So we want to dampen the exposure to growth stocks, lower the exposure to some of these big stocks that are controlling the main index, and then also diversify out of the US. So this kind of points to some of the reasons to do that from a risk standpoint. Do you have any?
When there's that kind of concentration, that adds a level of systemic risk that we don't want to necessarily take head on. So we want to diversify that. That's all I have to add there.
And this is, again, just the US, but it just gives you a sense over time of where valuations are. So valuations, as Allison mentioned, are pretty high in the US. They're high globally, but they're really high in the US. And you can kind of see, it's gone up and down. The interesting thing is that you can look at the standard deviation lines there, kind of represent, if it's above the top one or below the lower one, it's much less likely to happen. 2/3 of the time you're going to be between those 2 lines. Right now we're way above the what's called the 1 standard deviation event. And what that means is that's maybe a 10%, 11% chance of happening. In fact, the 2 things could change that. I mean, one thing is that you could have a correction. So there's more risk of a correction in the US market now than there would be if you were somewhere in the middle on valuation. The other thing that could happen is we could actually justify those valuations. You could have really high earnings in the US and you could catch up. But in any event, it's more likely that the US is going to underperform for the next, say, 10, 20 years, if you're thinking long term, than it would be if valuations were more muted. So, again, another reason to, if you can find other places to be that are less overvalued, another reason to be diversified.
Now, something I would add to that graph is, this is a we can see it coming, but we can't tell when moment. If the economy continues to boom, if AI continues to transform, it's quite possible that valuations will keep rising and the stock market will keep booming. We can't tell. What we do know is that if you look at the 2020 numbers, what caused that to recover was juice. That was the United States going deeply into debt. That debt bubble, which we just saw come to fruition in the Sachs bankruptcy because too much debt was created between 2020 and now, is producing, we've got that debt hanging out there, which is a risk. That's why Mike here has pushed our interest rate exposure down so that we're not really exposed to long-term bonds. That's what that's all about. We're just being defensive. The other thing to say is that, yes, this is a prediction of a storm, a guess that a storm is out there, but as Norm will tell you, sometimes storms happen and sometimes they don't, and it would be unfortunate to back completely off because there's a decent odds there won't be a storm for a while.
Yeah, and our view is that you don't want to, if you see this kind of thing, you don't want to just get out of the U.S. market. You just want to make sure that, because it could easily justify itself at some point with AI or whatever causing earnings to increase. But you do want to keep it at a level in your portfolio that if it does see a correction, if that storm comes to pass, it's not going to devastate you.
If I could add one last, I know I'm talking too much. You remember what the 2000 looked like. An average drawdown for the stock market is between 15 and 20% down each year. We tend to forget that because the year finishes well. But it's not abnormal to have a 10, 15, or 20% downturn intra-year that scares people. So you cannot get out of the stock market in advance of a decline. You can't guess when it really turns into a bear market. The only thing you can do is diversify the portfolio and hang on, and then rebalance, just your automatic rebalancing, will rebalance you into purchasing when the stock market is low. So the thing that you don't want to do is underestimate the emotional impact that this will have, because it will be big. The media will be screaming, as I've said before, and as we've seen before. You're allocated at the moment, so you can just ride this thing out.
Yeah, actually a really good example, which we got lucky on this, but in 2020, when COVID hit and everybody was really concerned about what's going to happen, the market took a big drop. And what ended up happening for us was because of this long-term view and that we just keep our asset allocation and rebalance. As it turned out, right near the bottom of that crash, we ended up rebalancing almost all of our client portfolios, buying stocks, selling bonds, because they had gotten out of balance because of this big drop in the stock market. Next thing you know, the whole thing recovers and we rebalance the other way. So that was a perfect example of how being sort of measured and not reacting emotionally and just applying our process, it really ended up helping our clients quite a bit. So that's pretty much what you're saying is stay calm, don't react to these things. Yeah. So it's expanding the valuation discussion out to beyond the U.S. You can see in that left-hand chart, the far left is the U.S. And what that shows is the purple's where we are right now, and then the little line in the middle is sort of the average over the last 20 years in this case, in this chart. So you can see how far the U.S. is above its sort of longer-term average. If you look at the other sectors of the world, they're all above their longer-term averages, but not nearly by so much as the U.S. So the sort of takeaway is everything's overvalued, but the U.S. is really overvalued at this point. Now, again, that's an indication that maybe we're going to see lower returns going forward, but you wouldn't want to just pull out of the markets because of this, because those returns could be justified. It could be that we have more growth in the next 10, 15, 20 years with, say, AI and some of the stuff that's coming out of that. And in which case, having gotten out of the markets, you would have shot yourself in the foot. So, we just want to be aware of this. Again, we want to be globally diversified so that we're spreading that risk around and not taking too much exposure to any one place. This is a good chart. This is looking at interest rates, and the purple line is going to be just the 10-year Treasury rate at various points in time. This goes back to the 50s, so it's like 80 years or something, or 70 years. And basically that's the actual published 10-year Treasury rate at various points in time. The line below is the real rate of return, and so the way that's calculated is you just take the Treasury rate and you subtract inflation for the previous 12 months. And I think they're using CPI in this one. And so you can see, so for example, back from 2021, you've actually got a really high negative real rate of return, which is not sustainable. I mean, eventually something adjusts. Either inflation comes down or interest rates go up. In this case, interest rates went up quite a bit in 22. If you look at the averages up top, real yields are what tend to be stable over long periods of time. Over this 70-year period, they're about 1.9%. So you get paid about 1.9% over inflation to hold 10-year treasuries long term. Right now it's at 1.56, so it's a little bit low, but it's not concerning. Back in back when the actual rates were getting close to zero, at that point we had very short-term bonds in the portfolio because we felt like with the real rates so low, in fact negative, it really was setting itself up for some kind of pop in interest rates, which actually happened in 22. Now we still always stay pretty short-term in our rates because we don't want the preservation piece of the portfolio to be volatile. But we're more comfortable now with rates a little higher, to have a little bit more exposure to longer maturities. Not very long, but say intermediate versus short. But this, just gives you a sense of where things are right now. And we feel like it's reasonably a stable spot at 1.56 versus the longer term average of 1.9.
Well, I have to add something here. You remember when the 2010s were going along, interest rates were getting low, were down low, and if you could go back one slide, it'll help me. There you go. And if you look, the real rate actually went negative, and countries were actually issuing negative interest rate bonds, where you had to pay to buy a bond in, say, the Bank of Japan or the Bank of Germany. And so next week, in 2026, the big Davos conference is going to happen, and all the billionaires will fly in their Learjets to talk about global warming. And the thing that gets me is The Economist will come out, and it will say something. And what they said in 2019 is that interest rates will never rise again. We've reached a permanent level of low interest rates. They'll never go up again. Inflation's dead. Interest rates will never go up again. And all these people at Davos and issued this pronouncement saying, we're worried about banks being able to survive in this era of no interest rates. And look what happened. Right when everybody decides the interest rate will never rise and inflation is dead, there we go again.
So just to kind of wrap things up a bit, looking forward, these are not predictions, but they're just more risks and opportunities that could come to pass. If fiscal deficits and debt continue to spiral, these are risks. If we have higher unemployment, more government shutdowns, which are very disruptive to everything in the economy and in the markets. The geopolitical conflicts that we're seeing, those could start resolving, but they could also hopefully do resolve. If they continue to escalate, that could cause problems. And then, we feel it's really important for the Fed to stay independent, and there's some potential for that to decrease, and we think that would be bad for the situation. In terms of opportunities, we think there's a lot of potential in AI to just add productivity, and if that happens and that causes boosts in earnings, that'll be good for markets. Global investment uptick, if that happens, if we don't stifle things too much with tariffs and so forth, that's another area of opportunity. If the tariff situation and the trade situation just stabilizes, that is a good thing for everything, for the economies and markets. And then consumer confidence is actually a little bit low right now. If that comes back, that helps everything. That helps the economy, prosper. And then again, if the Fed continues to lower rates, that'll also be good for markets. So we see all these things as just potential risks, potential opportunities. We don't have any predictions about these things, but that's kind of the landscape. Do you have any comments to add?
Not on that. 2026 is just going to be a very interesting year.
Yeah, it's a very uncertain time. We're not really clear where things are headed. So.
If you visited us in the Monterey office in our large conference room, there's actually a crystal ball sitting up on the credenza. And there's sort of a joke, if you look in it, it says that it's broken, basically, and because it is really, really hard to predict the future with consistency when it comes to the interconnectedness of the global environment and the markets. So that's not something that we aim to do. We really aim to focus on the things that really matter when it comes to portfolio management. And you'll see these here, and Mike and Pete can talk to those a little bit.
Sure. For one thing, you want, as Pete's pointed out too, you want to look long term. So you don't want to think about what's going to happen next year so much as, are you positioned to meet your goals and objectives over the long term? So that's a matter of diversification. That's a matter of having your portfolio positioned between growth assets like stocks and preservation assets like bonds that in a way that meets your goals, which kind of speaks to the second one as well. We don't focus on benchmarks if it was in the sense of you shouldn't compare yourself to the S&P 500 because, as we pointed out, that's concentrated and risky. You want to structure your portfolio to meet your goals. Disciplined approach, that's sort of rebalancing, that's not panicking. Broad global diversification, keeping your costs as low as you can, so not paying too much for products, for investment products and so forth. And then again, rebalancing systematically and without emotion.
Wonderful. I think we're about to eat.
Yeah.
Please keep your questions, and we'll come back up here after we eat if there's anybody who has questions. Yes, Norm?
I'm not sure I heard you, but when you were talking about international investments were not as high as the stock market, and yet this last year they were well up. I didn't catch the reason. Why did the international stocks jump so high? Because they've kind of been slow movers over a period of time, and you have a graph there that shows a significant increase in international stocks this last year.
Yeah, so a couple things. The U.S. has been much more overvalued than the rest of the world for a long time, and it even increased this year, but so they're coming from a lower valuation, which just means that there's more room for them to go up. And then I think with all the uncertainty and turmoil in the U.S., I think that drove more investment to international versus U.S. a little bit. Yeah, I mean, the U.S. still did well, but particularly driven by, as we noticed, those top 7 tech stocks. But that's part of it, and also the dollar has depreciated pretty significantly this year, and that really helps your international investments because all of our international investments are in the local currencies. So we buy something that's designated in the euro, like France. It's actually going to, if the dollar depreciates relative to that, that's going to be a bump in the returns, even if the companies don't do particularly well in their own country. But there's a little of both.
The dollar's value changes.
It affects it both ways. So for the past 15, 20 years, the dollar's been appreciating, and that's been hurting it. In addition to the U.S. stocks just doing better on their own, that's been hurting the international investments in addition to that.
I have to add, they really were that cheap. International investments really were at bargain levels. I mean, just incredibly inexpensive. And allocating into them always got kind of a shrug from clients about why are you buying something that hasn't moved in 5 years. And it's for years like this that we allocate into that because it's cheaper.
Yeah, I think this graph right here does highlight it. The lighter blue is the beginning of the year and the purple is the end of the year. So that just speaks to the kind of the lower valuation that we saw in international starting out the year, and then that increase that we ended the year.
And this is looking at the price to earnings ratio. So it's forward-looking earnings that it's basing it on. So basically valuations have gotten richer as those markets have gone up. Even though earnings go up, prices went up more.
I also have to add that we would never put 100% into international. The thought that crosses your mind, if it's really cheap, why don't we put everything into it? And the answer is because the future is that unpredictable. You don't know. So diversifying for its own sake has value.
Staying on that slide, do you have any thoughts on the sectors? It's easier for people to say.
Well, I mean, this is just showing that all these sectors it's affected across everything. So international is, and that's kind of a strange chart. It's basically showing the difference between the U.S. and the non-U.S. So the MSCI ex-U.S. is basically everything that's international stocks, everything that's not U.S. And so the only thing that tends to have higher the only sector that tends to have higher valuations internationally over longer periods of time is healthcare. Everything else tends to be lower than the U.S., but right now it's even more so, and that's why the purple is to the left. The only point there is that it's broad across all sectors. But basically international is less highly valued than the U.S. at this point. That's a sort of international versus U.S. as opposed to just static valuations. So I don't know.
So that explains something else you saw in your portfolio, which is after decades of world-beating performance from our healthcare. I mean, in the 2000s, healthcare saved us. Healthcare is awesome. We're now diminishing it somewhat, and one of the reasons is to add diversification because healthcare got pretty big. But there's another thing there. You can see that healthcare is actually rich compared to other alternatives. If right is cheaper, then the bargains are international in all those other sectors. So that's why healthcare got reduced, one thing it had done awfully well in the last 20 years. But that's why healthcare got reduced.
Does that answer your question?
I was wondering if you have any thoughts on the future of the sector.
Like which sectors? Not in any particular. I mean, I think, you know, technology is kind of, particularly in the U.S., technology is really highly valued right now with all of these stocks. But then the question is that going to be justified? I mean, it's possible. If some of the stuff that's going on ends up really increasing productivity and these companies do well, then, you know, those high price earnings ratios could be justified by higher earnings. So it's just not clear, you know, it's not clear that there's one that's likely to blow away the others, I would say. Sure.
Asking about this, you see a lot of ads for holding physical silver and gold.
Yeah.
What do you thought of that?
I mean, we're not a big believer in that. I mean, holding it physically, I mean, you have to, what is it going to protect you against, you know, I think is the question. And if the world goes into complete chaos, you know, are you even going to be able to protect your gold and silver, right? So is it really going to help you? But in terms of, like, if you don't think of holding it physically versus, say, in a vault somewhere, I mean, it's very concentrated commodity exposure. You already have a lot of exposure to commodities, including gold, silver, and oil and so forth, just by holding stocks, because a lot of the companies have positions in these commodities. So by being in the stock market, you already have a lot of commodity exposure. And we feel like any commodity is not a producing asset. It's just sitting there and you're kind of paying to store it, versus any you know, stocks, bonds, and so forth are actually producing something. They're producing interest, they're producing earnings. And so you're the only reason you're really holding them is if you feel like it's a hedge against the world collapsing. And so I think, you know, that's possible, but I think you have bigger problems if we go to that level of apocalypse.
Yeah,
Then,
another question with the world monetary thing, we're talking about Europe and all the different countries getting together and, you know, making actually a world economy, right, rather than each nation having their own.
kind of like, I mean, they've already done the currency-wise. They've got the euro, which is a big chunk of it. Is that what you're thinking of?
Yeah.
I mean, I don't know. I don't have a strong opinion as to whether that's good or not. I think having the euro and having the eurozone has made Europe more efficient in a lot of ways. So that's probably good for productivity. I think it's really difficult when you allow people to have sovereign nations that make their own decisions to try to put them together. Tell them you all have to listen to one authority because, like, the UK said we're done with this and they left. And so, can you really make it work long term? I think it's questionable unless you really do combine those countries and they end up under one sovereignty. I think that's my view, but I'm not an expert on that. But
I have to add something here. You already own gold in the form of your diversified holdings. So you've got some. But I want to add to Mike's comment that gold is essentially a disaster trade. Gold is a fear trade. What sells gold is the fear that everything's going to blow up. If it does not blow up, then you're holding a sterile asset. So if you look at the history of gold in the last 30 years, you see times like the 1970s when the Saudi oil crisis was happening. We thought everything was going to go to heck. Inflation reached, 16% in the United States and much worse overseas. And so you saw people buying gold. Gold was correlated with rising interest rates. In the 20-somethings, you saw interest rates plummeting, a fear that the economy, if you turned on the media in 2009, there was a perception that the United States was going to default. I mean, there was a whole bunch of doom out there. Gold, again, started rising and went on a run because people thought, the end of the world is nigh. Which, when you think about it, kind of defeats the logic of it. But gold is a sterile asset. It also will decline precipitously and suddenly and lay there for decades. So I've had in my experience clients who bought great quantities of gold and then had to deal with it dropping to 25% of its former value and laying there forever. The best use of gold, if you have to own it, is as a hedge, just a hedge, which means it's a small percentage of your portfolio. But even then, unless something bad is going on, it doesn't work. The recent run-up in gold is in part created by the international market buying gold, including some central banks buying gold because they're concerned about the United States. They're hedging their dollar, in other words. So that's what's causing the price of gold to go up. But there's also an equal chance it'll plummet like a brick if things turn out right.
Any other questions? Well, that concludes the conversation today. Thank you all for coming. You may have noticed that we are recording today, so we're going to put together a little video so that when we're going to send it out to everybody so that you can revisit it and review it as you please or share it with your spouse. And that will probably take a couple weeks, but we'll get that out to you guys. Feel free to continue to mingle, enjoy yourselves, and have a wonderful afternoon.
Any other questions?